up the next session of MMPF002 on the subject capital investment and financing decision. I am ASEEM Kumar and your resource person. Friends, till September 10th, we have covered 3 blocks. In block 1 on financial decision and overview, we have covered unit number 1 for nature of long-term financial decisions, unit 2 for cost of capital, unit 3 for capital structure decisions. In block 2, we have covered 4 units. The major title was investment decisions under certainty. Under this particular major title, we have covered unit 4 for project planning and formulation, investment appraisal evaluation center under block unit 5. For unit 6, we have covered project implementation and control, and under unit 7, we have covered social cost benefit analysis, SCBA. And in the last session, we have covered block 3. In the block 3, it was on investment decisions under uncertainty. And with this major topic, we have covered unit number 8, investment decision dash risk and uncertainty, project evaluation under risk and uncertainty under unit number 9. So with that, up to 10th of September, we have covered 3 blocks of this particular course. And now we are going to take up block 4 today for 3 different topics. So today we are going to take up block 4 on the title long-term financing decisions. We are going to cover unit 10 for financing through domestic capital market. Under unit 11, we will be just discussing and starting about financing through global market capital markets. And under unit 12, we are going to cover the other modes of financing. So we'll start with unit number 10 under the major head long-term financing decision. Friends, long-term financing decision, in any case, we have to understand that you will be needing some funds for a longer term. It means that. And if suppose you are to just go for a decision for the long-term financing, you have to see what kind of funds you are going to procure, what kind of decision you are going to take for financing your long-term needs, and how these funds are going to be collected. We may be having the indigenous, the domestic market, but once we are a multinational or we are just doing the export or import, we become multinational. We are dealing with the other countries as well. So once you are becoming a sort of company dealing with the business decisions of different countries, then you can have the financing through global capital markets. We are going to discuss about. And apart from having the domestic and global capital market, we are going to cover the short-term and the working capital decision financing, other modes of financing for our concern. So here we are just going to take up the long-term financing decision, unit 10 at first. So unit 10 is financing through domestic capital market. Let us just look at what it is. See, the economic growth implies a long-term rise in the per capita national output. The basic condition determining the rate of growth are effort, capital, and knowledge. Among these, capital information has been recognized as the most crucial factor in the economic growth of the developing countries. Why? Because capital formation implies the diversion of the productive capacity of the economy to the making of capital goods, which increase future productivity capacity subsequently. The process of capital formation thus involves transfer of savings from those who have them in the hands of those who invest the same for productive purposes. Friends, saving and investment activities are linked with finance, both saving and investment. Somebody is saving and somebody is just making the investment, and they have a sort of combination and bonding as well. So with that bonding, they are just going to cover with that, right? So finance provides the mechanism through which savings of myriads of savers are pooled together. See, different savers, different people who are saving the money. They are depositing their savings to some organization where it is pooled together and then are put into the hands of those able and willing to invest. You then start investing that pooled money because you are to earn the return on that. Unless you earn return, you will not be able to just pay them the dividend or interest as the case may be. The mechanism includes a wide variety of institutions which cater, on the other hand, to the safety, liquidity, and profitability notions of these savers, and on the other, to the different types of requirement for working and fixed capital of the investors. So it is two-way. They are looking after the saving part. They save all those people who are saving the money, and they'll be looking after the investors' interest also, because whether it is working capital or fixed capital, in both the cases, they are investing in different securities. Normally, these institutions are grouped into money market and capital market. Money market and capital market. We can simply understand when it is just coming out to be the high liquidity form, it is money market. But when we need the money for a longer term, it is catered by the capital market. Let us just understand how it is. Money market comprises those financial institutions that cater to the notions of savers who prefer high liquidity. There are many. If you are just going for a sort of labor-oriented industry, definitely you will be needing high liquidity because you have to just pay them on daily basis. It may not be just weekly, but on daily basis sometimes. So they prefer high liquidity and safety, with safety of course. You can't just have the liquidity with the unsafe or risky affair, and safety along with the decent return, and provide working capital to trade and industries mainly in the form of loans and advances. So what is that? The money market is a reservoir of short-term funds. Money market is a reservoir of short-term funds. Money market provides a mechanism by which short-term funds are lent and borrowed. It is through this market that large part of the financial transactions of a country are cleared. It is a place where a bid is made for short-term investable funds at the disposal of financial and other institutions, individuals, and the government itself sometime. If financial needs and long-term investments, we need to go for the capital market. What it does, the capital market is the place where the medium-term and long-term financial needs of business and other sectors of the economy are met by financial institutions, which supply medium and long-term funds to the borrowers. Medium term, it is more than 3 years, 1 to 3 years, and then sometimes it is more than 3 years but less than 5 years. But when the period goes beyond 5 years, we normally we just presume that it is a long-term financial need of the business. Okay. So according to the period, if it is less than 1 year, then of course it is the short-term investment or short-term requirement, fund requirement we have. But if suppose it is more than 1 year but less than 3 years, on an average this is called medium term. And if it is more than 3 years and even 5 years also, we normally tend to presume that these are the long-term financial needs. The capital market is composed by primary market and secondary market. Now, what is primary market and what is secondary market? These are the stock market. The primary market provides a mechanism through which the resources of the investing public are mobilized. Okay. And in a larger interest, if you just see primary market, when you are just issuing the shares or securities for the first time. So this is called a primary market. Whereas once the public is mobilized, once they have invested in their shares, the secondary market provides the next course of action. This is the mechanism to facilitate an investor to buy and sell the securities through dispensation of benefits of easy liquidity, transferability, and continuous price discovery of securities. Thus, both the primary and secondary market play an important role in raising maximum resources for capital formation for balanced and diversified industrial growth of the country. Industrial growth in the country. What are the methods of procuring finance? A company can raise funds through capital market by issuing the financial securities, as I told you. The financial security is a legal document. Mind it that whatever document you are issuing, whether prospectus or call for shares, it is a legal document. Once it gets approved, then only you can issue that. So it is a legal document and that represents a claim on the issuer. Anyone who is issuing, there is a claim on them. Okay. The corporate securities are broadly classified into ownership securities and creditorship securities. So friends, the securities are two kinds. One is the securities which are belonging to the owners, and there are certain securities which are belonging to the outsiders. Outsiders. They could be supplier, they could be loan givers, they could be anyone who have given their services but you have not paid them for their services or otherwise. So all those things are coming in the balance sheets, credit side, the liability side. So better that we can just put them in the hybrid securities, or we can just show them according to their property, whether it is ownership security, then it is equity share, preference share. And if it is just coming out with the creditorship securities, then it is coming out with the debentures, the deposits, bank loan, and others. There are also securities known as hybrid securities, having the mix of the features of ownership security as well as creditorship security. Okay, as well as the creditorship security. It is a mixed bundle in that security. The company can also raise the funds through public deposits and borrowings from banking sector. You see, the banking sector is just playing a very vital role under these, that you can just buy, you can raise the funds through public deposits, and you can convince the bank also for issuing the money or the funds to you for a longer term. Okay, it could be for a shorter term also, but on an average, we presume that it is just coming out to be for a longer term. So each method of financing has got its distinctive feature, terms of risk, return, control, repayment requirements, and security. In सबके definitely the method would be different. The term of risk would be different. Their returns would be different. Their control mechanism would be different. The repayment requirement would also be different. And finally, the security. It following all those earlier points. Depending upon the market condition and financing strategies, the issuer adopt different methods. What market says and what are the financing strategies of the company? Accordingly, they just issue the securities. Friends, first and foremost, which is called the ownership equity securities, are equity shares. The latest amendment, according to the Companies Act 2013, a share is a part of unit by which the share capital of a company is divided. Suppose you have 1 lakh share of 10 each. That means you are having the authorized capital of 10 lakh. Out of that, if you have issued 10,000 shares, that means 19,000 are still pending. These have not been issued. You have issued only 10,000 shares for ₹10. You can just take up this a small sample also, but bigger and small, it matters according to the accounting point of view. So according to the Companies Act 2013, a share is a part of unit by which the share capital of a company is divided. The Act makes a provision for only 2 types of share capital: equity share capital and preference share capital. So preference share capital, definitely people will be having a sort of edge about. They'll be having so equity share refers to the share capital which is not preference share capital. There is no preference on this. They are the pure securities which belong to the owners. Equity share capital is also defined as the amount of the value of property over and above the total gains and charges. The word equity share capital is whatever the debts remains in the way of assets after all and other charges have been paid or provided for. That is called equity share capital. Finally, we can just say the equity share capital is also appropriately referred to as residual capital. And once it is just coming over to the residual capital, it represents the owner's equity. It represents the owner's equity. Friends, those who are having the, say, equity shares, they are having the right issues also. It is their right. So under section 62(1) of the Companies Act, the existing, not exiting, it is existing shareholders of a company have a right to subscribe for new equity shares. New equity shares. Okay. If the company intends to raise additional equity capital in proportion to their shareholding, these shares are called right shares. Instead of acquiring the rights shares, the debenture holder can transfer the right to others and can imply forego them. These shares not subscribed will be allotted to the other shareholders, applying for more proportionately. This is about the right shares, right issues. There is something which is called private placement. You cannot just do it for the entire one, but there are some shares you can just issue the private placement as well. It could be the government organization or maybe a private organization altogether. Private placement, in this method of raising capital, shares will be issued in bulk to the issuing houses through financial intermediaries, investment companies, and other companies. Can just look at it. It is a private placement, so they are just finding out many people who will be looking after the interest of that company. As per SEBI guidelines, SEBI norms, a company cannot issue shares to more than 99 persons under private placement. Now, as per SEBI norms, a company cannot issue shares to more than 99 persons under private placement. Often these institutions buy the shares through private placement with an intention to make profit by selling them to the investors in the secondary market through clients. The sale can take place in short term or long term. Depends what is the need. While issuing, bankers and brokers normally resell the shares acquired through private placement in the short term, because for them it is a daily routine, issuing the shares and then selling them off. So as a normal routine, they share it, they sell it off in a lesser block time. Okay, they start giving you the negotiable floating cost, if any, better price for the shares. Now, once while issuing, the bankers, brokers normally resell in the short term. This method has the advantage of negligible flotation cost and the better price for the shares. Let's just look at it, non-voting shares. As per the provision of Section 43 and 47 of Companies Act 2013, companies can issue the equity shares issued with the different right as to dividend, voting or otherwise. This implies that these holders of these shares will have rights different than rights attached with the equity shares with voting rights. So when a company issues equity shares with the different rights, then only you will get these kind of shares. They are required to adhere to certain conditions. What is that? The Company Share Capital and Debentures Rules 2014, that is a year after, lays down several conditions for a company to issue equity shares with differential voting rights. And one of the main conditions is that at any point of time, shall shares with differential rights shall not be exceed not exceed 26% of the total post issue. Paid up equity share capital, including equity shares with the differential rights and issue. Now, they have to record what 26% of the total post issue paid up equity share capital. It is inclusive of equity shares with the differential rights issued. Friends, now we have a preference in the shares, and therefore these are called preference shares. What preference they are getting? In terms of payment of dividend, in terms of payment at the time of liquidation. So preference shares are those which carry certain preferential rights as compared to other securities. As I have just mentioned right now, the preference shareholders have the right to get dividend at a fixed rate prior to any class of shareholders. Similarly, the preference shareholders get repayment of capital before any other class of shareholders get it when the company is liquidated. In other words, preference shares have prior claims over equity shares on earning and assets in the event of liquidation, but it rank below the creditors. It rank below the creditors. Our next category is CCP, Cumulative Convertible Preference Shares. See, the name itself is just giving you the idea. Cumulative Convertible Preference Shares. The government in 1985 introduced the Cumulative Convertible Preference Shares. The features of CCP are: the CCP can be issued by any public limited company to raise funds for new projects, expansion, etc. The amount of funds raised can be to the extent of equity shares to the public for subscription. The dividend payable is 10%. See, it is a fixed amount. The entire amount of CCP would be convertible into equity shares between 3 and 5 years. That means at first these are issued as preference shares. Over a period of time, these preference shares are given the option to convert their equities to the equity share. The entire amount of CCP would be convertible into equity share between 3 and 5 years. This instrument is yet to become popular because the convertibility, there are many ifs and buts, there are many thought processes are coming. So companies did not prefer it because the dividend on CCP is not tax deductible, as in case of interest on debt. This was one of the, say, factor which was not making it popular at a larger scale. Next is the warrants. These are similar. Warrants means it is not a police warrant, but these are financial terms. The dividend warrants are just coming out which make you eligible to have the dividend amount. Cash warrants, cash vouchers, we can just call it cash warrants as well. So warrant is similar to call options. It is the right to buy a share of a company which issues them at a certain price, a specified period of time when a warrant is exercised. The number of shares of the company increases at the same time, resulting in cash flow for the company. Warrants may be issued in the following circumstances. Warrants may be attached to the sale of new equity shares as sweetener, through exchange as a result of reorganization, through separate sale as issued to promoters of some Indian companies to strengthen their controlling powers. Okay? But this is not a common practice. This is not a common practice. Debentures. Debenture is our loan capital. Till now, we have been discussing about the own capital. Okay, the owner's capital, but now it is the outsider's capital. So we call it loan capital. The debenture are ones of the principal source of funds to meet long-term financial needs of the companies. There is no specific definition of debenture according to the Companies Act 2013. The word debenture includes debenture, stock, bonds, and any other securities of the company. Thus, a debenture is widely understood as document issued by a company as evidence of debt to the holder, usually arising out of loan and mostly secured by charge. Always these kind of securities are having a charge on the assets. The major difference between the shares and debentures are as follows. It's very important to know what the equity shareholders have proprietary interest in the company, whereas the debenture holders are only creditors of the company. First difference. The equity shareholders have voting rights, whereas debenture holders do not enjoy such a right because they are the owners, shareholders. Debenture holders are entitled to interest at a fixed rate, whereas the equity shareholders are entitled to dividend at varying rates. Debentures are usually redeemable. You can just get the payment back after 3 years or 5 years or something like that. Therefore, have maturity period where the equity shares are not redeemable. The equity shares are not redeemable. So whereas the equity shares, these are not redeemable. Debentures, you can get your money back, but equity shares, no. It is only at the time of liquidation you will get the money back. Debenture holders have priority over shareholders in the distribution of assets on liquidation of the company, as I said right now. Bonds, not J bonds. It is a bond between the creditor and the issuing company. A bond is a creditorship security whereby a company obtains money from the lenders for a promise to pay the stipulated rate of interest at specified intervals and to repay the principal on maturity, and they get the principal sum on maturity, which is also mentioned in the agreement. The bondholders have a priority claim on the receipt of interest and repayment of principal over other creditors of the company. So, in between the creditors also, you have the priority in case of the bonds issuance, because interest has to be paid to the bonds first rather than giving this sharing of interest to the others first. So bonds are different type like secured and unsecured bonds. The bearer bond, perpetual bonds, sinking fund bonds, zero coupon bonds, convertible bonds, floating rate, zero coupon bonds, convertible bonds, floating rate bonds, etc. Friend, once again we are having the security premium notes, SPN we call it. Tata Iron and Steel Company was the first corporate to issue SPN on good rights basis. The main feature of SPN as issued by TISCO are as follows. The face value of a SPN was rupees 300 and no interest will become due or accrue during the first 3 years after allotment. See, it is a different connotation altogether. Therefore, each SPN will be repaid in 4 annual installment of 75 from the end of 4th year, together with an equal amount of 75 with each installment, which will consist of a mix of interest and premium on redemption. Further, each SPN will have a warrant, watch do it, which will give the holder the right to apply for and seek allotment of one equity share for cash payment of rupees 80. Such rights are exercisable between the first year and 1.5 years after allotment. Thus, SPN can serve as long-term security and given more flexibility to the companies as well as investors. Friends, our next raising fund option is public deposits. The name itself gives you the idea. According to the Companies Act 2013, all types of money received by a company except the contribution to capital would fall in the category of deposits. Okay. Now, fixed deposits, which are also known as public deposits, have become attractive for companies as well as investors. Let us just understand, do we have any freedom in inviting these public deposits or otherwise? For the companies, public deposits are easy form of fund mobilization without mortgaging asset. Without mortgaging asset. Bank credit. Bank credit, including the development finance institution, have become chief source of funds to the corporate sector. What they do, in other words, the industrial credit is a major revenue earner to the banking sector as well as other types of credit like agriculture credit are subject to many restrictive conditions and regulations of RBI, and therefore margins on such credit are very thin. Friends, normally bank extend credit to the industries and commercial establishment are varying rates of interest depending on their credit worthiness of the borrower as well as period of loan. We have the next source of funds, venture capital. The objective of the venture capital is to encourage those desiring entrepreneurs by providing long-term capital without the risk of losing control. By 1980s, the USA had well-developed venture capital market. In India, venture capital market is emerging as a new source of funds. Friends, with that we have completed our unit number 10. We are moving on to unit number 11, which is financing through global capital market. We are now raising our bar. We are crossing the country's limits and going for the multinational raise sources for raising the funds. Friends, in the financial circle in the recent years, the word globalization is often heard. Globalization. It says that the globalization means the entire world is a village. We all are neighboring people to each other, and therefore having a bond for investment and for saving, and vice versa. So most commonly with reference to the heightened internationalization of financial transactions, but natural because the entire world is a globe, is a village. This catchword sums up the phenomena in which financial transactions increasingly transcend the geographical and time limitation of local financial markets, giving rise to a single uniform global market. Giving rise to a single uniform global market. While the phrase internationalization refers to cross-border transaction among national markets, globalization goes beyond national frontier to create borderless market in which national borders gradually disappear. The international financial system is characterized by the following types of institutions: financial market, banking sector, foreign exchange market, special financial institution such as the World Bank or IMF, etc. Deregulation of financial market. Friends, our markets were regulated earlier, but over a period of time, with the floating exchange rate regime in 1973, interest rate deregulation and securitization since 1970s have been among the major factors behind the steady progress of financial globalization. Financial globalization. The opaque phenomena of the 1970s and debt crisis triggered by the developing countries in 1980s also significantly influenced by the volume of international capital flows and restructuring of financial system as a whole. The innovative financing techniques are constantly being designed to turn the financing game instead of the zero-sum game that was witnessed in the 1980s. The innovativeness in financial techniques and tools have also been accompanied by the growing deregulation of national financial market, characterized by relaxation of barrier, separating the activities of different types of institutions, relaxation of interest rate ceiling, extension of the geographical domain of existing institutions, and reduction of barriers to entry into the domestic financial system by both foreign and non-banking institutions. The abolition or relaxation of exchange controls, the elimination of quantitative credit ceilings, the removal or reduction of withholding tax on interest earning of non-resident, and changes in regulations governing access of foreigners to domestic market and the access of resident to international markets has tremendously helped the national market to forge a global financial market. The increasing competition amongst banks themselves on the one hand and between the banks and non-bank on the other for providing finance and financial services compelled banks to look into hitherto uncharted territories. So what happened in the banking sector? The developments in the banking sector. The banking sector too has gone through revolutionary changes. At least three trends characterize the future of banking the world over. The bank's role as funding intermediaries is diminishing now, and instead, banks are taking on the role of broker or underwriter for credit transactions. Banks' formerly protected turf is being invaded by investment banks, thrifts, insurance companies, and even retail firms. In response, banks are expanding their activities into the domain of investment banks, insurance companies, and finally, banks are expanding geographically as they compete in interstate and even international markets. However, although the role of bank play as funding intermediaries is diminishing, it will not disappear entirely, frankly speaking. Developments in the foreign exchange markets. The foreign exchange market exists because of the trade between countries with different currencies. That is, exporters prefer not to hold foreign currencies. They want to be paid in their national currency. Foreign exchange transactions have thus become an integral part, even essential part of the intermediate international trade and finance. In the immediate aftermath of World War II, foreign exchange trading was relatively limited as most major currencies were subject to extensive exchange controls. And the opportunities for the movement of funds across national boundaries were severely limited. It is the earlier part we were just talking about after the World War II, but the subsequent recovery and growth of the world economy brought a gradual relaxation of these controls. And as a result, foreign exchange trading became more and more active. Global source of financing, the foreign bond market. The foreign bond market is that portion of domestic bond market which represent issues floated by foreign companies or governments. In context of US or Germany, the bond issues floated by Indian and any other foreign corporate or government and subscribed by residents or corporate of these countries will represent the foreign bond market for them. The foreign equity market, like the primary and secondary market in the domestic domain, but now it is just coming up the other market, which is just coming up in the international arena. When companies decide to raise equity capital from diversified investors, the natural choice is cross listing of shares of the company over various stock exchanges located in different countries, either through initial public offering or through seasoned equity offering. Foreign listing allows companies to diversify equity funding risk. Sometimes the equity offering are large enough that a single domestic market may not meet the entire funding requirement. So you need to have the requirement to be fulfilled by the other foreign countries as well. Foreign offering can increase the potential demand of the company's share and hence the price. Foreign bank market. The foreign bank market represents the portion of domestic bank loans supplied to the overseas customer for use in the other country. Project finance. Whenever you are just having the project, a sort of activity, when the banks are becoming interested, they are Financing in the large scale, capital intensive, long term capital investment are usually financed through project finance. The project finance is a non recourse lending secured by project and potential cash flows associated with the project. A new phenomena has come, the euro currency market. The euro currency market is outside the legal purview of the country whose currency the finances are raised. The term euro is affixed to an offshore currency transaction. Capital raised in the euro currency market can be classified temporarily as under. Euro loans are essentially short-term accommodations provided by the bankers to their clients. The interest charge is a mark up to the London Interbank offered rate, LIBOR, which varies according to the credit worthiness of the borrowing company. Euro commercial papers are short-term promissory bearer euro currency notes. These are typically issued at a discount of their face value, which represents the yield to the investors. Normally syndicated euro currency loans are given by the syndicates of the banks to the borrowers at variable rate of interest, e.g. LIBOR plus 0.25%. It is about the syndicate banking. Revolving underwriting facility involves sale of bearer notes to the investors on a revolving basis. Euro bonds are long-term unsecured debts securities, usually fixed rate instrument with bullet repayments. And finally, euro equities are company shares which could either be directly offered listing on the foreign stock exchanges or to take the form of global depository receipts with shares underlying such receipt. Raising of foreign capital in India. Capital can be raised from non-resident either in the form of equity or in the form of debts by Indian companies subject to Foreign Exchange Regulation Act, now it is FEMA, and other relevant provision in this regard. For raising of equity capital, ADR and GDR route has been used by the corporate, which has further refined with the introduction of Depository Receipt Scheme 2014. The scheme repealed the earlier issue of foreign currency convertible bonds and ordinary shares through Depository Receipt Mechanism Scheme 1993. It is called FCCBD RMS 1993. External commercial borrowings. External commercial borrowings are commercial loans raised by eligible resident entities from recognized non-resident entities. The main attraction for using this type of funding is low interest rate at which they can be raised. The parameter given below apply in totality and not on a standalone basis. Foreign direct investment. Foreign direct investment is the investment through capital instrument by a person resident outside India in an unlisted Indian company in 10% or more of the post-issue paid-up equity share capital on a fully diluted basis of a listed Indian company. It is becoming popular because foreign direct investment is very necessary for any developing country as it brings not only badly needed financial resources, but the new technology in terms of technology transfer. Since 1991, India has made hectic effort to attract FDI and in the process has entered into top 100 club on ease of doing business. Friends, with that we have covered our unit number 11 and now we are just going for unit 12, other mode of financing. Raising funds seen as an important activity of finance managers. Business units require funds for two reasons: to acquire fixed assets or to run the operations of the units. Several factors influence the need for funds, and typically a growing firm needs more funds year after year. Non-traditional source of long-term financing. We'll now discuss four such sources of alternative long-term finance available. One is the leasing and hire purchase, suppliers credit, asset securitization, venture capital. Leasing and hire purchase means firms need finance to acquire assets. Instead of borrowing and acquiring assets, it is possible for firms to acquire assets on lease. There are two types of leasing: operational lease and financial lease. Where the financial operational lease is used when the assets are used for temporary period, and the asset is returned at the end of the short period. While the operational lease is not considered as source of finance, financial lease is used when the assets are required permanently or for a longer period. Normally, the assets are ultimately purchased by the firm from the lessor at a nominal value later. Supplier credit. Instead of just going for a lease, what they do, they are just taking the asset on credit basis. Fairly simple and existence of a long time. Under this, the equipment supplier provide a long-term credit, accept the payment for a longer period, say 5 to 8 years. In that process, company which acquires the asset neither take bank loan nor approach the leasing company for credit, but directly takes the credit from the supplier of the equipment. In the other words, the supplier of the equipment act as a lender or lessor. Asset securitization. Asset securitization is a fairly simple concept. It is the process through which an asset is converted into financial claim. In other words, it brings liquidity to an illiquid asset. The concept is very popular in housing finance. The venture capital says the credit securitization are debt financing. Venture capital is an equity finance. It is investment at early stage, high growth project which are high risk with the potential to give extraordinary high return over a period ranging from 3 to 7 years. The risk factor being high, the probability of failure is also high. The return of the venture specialist capitalist are from the handful of the project which succeed. Friends, we are having non-traditional services of short-term financing. Firms can raise short-term finance from the banks and other investors. However, in the recent time, new method of financing are also to be used to raise finance for working capital. Commercial paper with good credit rating can raise money directly from the market, working capital purpose, by issuing commercial papers. Commercial papers are unsecured notes but negotiable as liquid. Why firms issue commercial papers and other invest in commercial paper? As discussed earlier, loan typically binds both lender and borrower for a period. The option for exit is difficult to exercise, whereas instrument like commercial papers enable both lenders and borrowers move out of their relationship in a short period of time. Since lender and borrowers meet directly, the costs of commercial paper borrowing will be lesser than the working capital loan. Factoring service. Factoring is essentially a management financial service designed to help firms better manage their receivables. It is in fact a way of loading a firm's receivable and credit management to someone else, in this case the factoring agency or the factor. Factoring involves an outright sale of receivables of a firm by another firm specializing in the management of trade credit called the factor. Under a typical factoring arrangement, a factor collects the accounts on the due dates, effects payment to its clients on these dates, irrespective of whether or not it has received payment or not. and also assumes the credit risk associated with the collection of accounts. For rendering these services, the factor charges a fee, which is usually expressed as a percentage of the total value of the receivables factored. Factoring is thus alternative to in-house management of receivables. Friends, with that, we have covered the unit 11, 10, 11, and 12. And so with the block 4, in the next session, we are going to cover block 5. And with that, we will be finishing this course as well. Thank you very much for a patient listening and your consideration on this course and the dissemination. Thank you once again. Namaskar.